Welcome to Market Overtime. I'm Diane King Hall. On today's episode, we're going to dive into the state of the housing market, and who better to give expert analysis than our guest, Daryl, Fairweather, Chief Economist at Redfin. Daryl, thank you so much for joining us today. So let's start out with kind of setting the stage and a look at the landscape of the housing market. How would you describe the current state of the housing market from your point of view?
The housing market has been in a deep freeze. It's been in this state ever since mortgage rates started going up around summer 2022. Home buyers have backed off the market, home sellers have backed off the market, so we have near record low home sales, and at the same time prices are still high, mortgages are still really expensive. So there's not much activity right now. The market is starting to shift a little bit in buyers' favor as we see more homes selling for under listed price. But given that mortgage rates have declined this last week, it's easy to imagine the market heating right back up again.
Okay, right. And mortgage rates have started to move a little bit. It hasn't been much, though. And when you think about where prices stand, they've been at all-time highs. You haven't seen the unlocking that you had hoped for, or that one had hoped for, at the beginning of this year. So what is it going to take to unlock this housing market?
I think, unfortunately, it's just going to take time. It could take really a decade to unlock the inventory that was locked in when mortgage rates fell to 3% during the pandemic. And that's just the nature of the 30-year fixed rate mortgage, that people were able to lock in these record low mortgage rates and have these low payments. So it's going to take a lot of motivation to get those people to move. There are things more important than just money when it comes to having a home. People need to move for all kinds of reasons, like marriage, divorce, death, new baby. So we are seeing more new listings at the market this year compared to last year, and we'll probably see an increase again next year as well, but it's going to take a lot to get us back to pre-pandemic levels of listings.
So more new listings, but one theme I've consistently heard about is that inventory has been a challenge, especially when you kind of think about single-family homes, etc. Is that still one of the difficult pieces that's facing the housing market today?
Well, if you were to look at the number of homes that are for sale on a website like Redfin, you might notice that there are more homes for sale now than there were this time last year, but not by a whole lot. And the homes that are on the market are the homes that are tending to sit there and accumulate, ones that are probably listed for too high of a price. And they are sometimes the more expensive homes. We're seeing more new listings in the expensive range than at the affordable range.
So, and when we think about affordability, so we saw most recently that the average rate on the 30-year fixed mortgage came down a little bit below 7%. What's the number that unlocks kind of the rate of affordability for more buyers to be ready to move?
Well, the vast majority of people have mortgage rates under 5% if they have a mortgage. And that's probably where we would see inventory materially start to unlock. But I don't think we're going to get there next year. It will probably take a couple of years for rates to stabilize at around 5%.
Okay, so for rates to stabilize at around 5%. During the pandemic, a lot of people got really nice rates. They had this 3%, below 3%. Could we see numbers like that again, or is that really, really far down the road?
If we saw 3% mortgage rates again, it would be because we're in a recession. That's why we got them during the pandemic, because there was a pandemic recession and the Fed pulled out all the stops to stop the recession, which is what the Fed's job is. And if there were another recession, they would certainly lower rates to combat it, which would create an opportunity for home buyers. But when a recession is happening, people are out of work, they're losing income. So it may not be the right time to buy if you are also facing that harm from the recession personally.
And then when you think about affordability, there's often, I hear from different housing experts that even the levels that we're out now is not the most unaffordable when you think about it on a historic basis. But what would you say to that?
It kind of depends on what you're looking at. Perhaps if you look at national prices and mortgage payments, there were points where they were less affordable given prevailing incomes. But if you are trying to buy a home in one of the economic centers of the US, such as New York, Los Angeles, San Francisco, Seattle, it's going to be very difficult, very expensive, and those high mortgage rates make it even more expensive. And that's where the good paying jobs are, so I think it's a very difficult trade-off to make. It's not like a lot of people could just move to a more affordable area and get a home. I mean, some people can with remote work, but many people don't have that option and they are stuck with unaffordable housing.
And then when you think about affordability and, kind of your outlook on it at Redfin as, a housing market watcher, you talked about in a recent article that you all have out about affordability now increasing for some people since, the average rate has come down a little below 7%. What's the risk of waiting for a rise in affordability?
Well, there's risks on both sides. So if you move now and lock in one of these 6.8% mortgage rates, there's a chance that mortgage rates could continue to fall, and maybe you're kicking yourself you didn't wait longer. But at the same time, if you do wait and mortgage rates do fall, that would be happen at the same time that more people enter the market, because those low mortgage rates would certainly bring new buyers into the market and spark competition, and that would, I think, reach a peak in the spring. And we could see bidding wars become the new norm again. So it kind of depends on whether you are willing to wait and fight it out against more buyers, or you'd rather just take the inventory and the homes that are for sale now at the prices that are now and call it a win that you're getting at least a slightly lower mortgage rate than what you would have gotten in May.
And then when you think about kind of where sales have stood, the spring selling season wasn't so hot this year, wasn't hot last year. Sales of previously owned homes fell during the spring months. When you look at the kind of inventory issue, what does the data tell you all at Redfin about what inventory looks like, especially kind of through the balance of this year?
Well, there's about 2.5 months of supply on the market. That means that it would take 2.5 months for all of the supply to be bought up at the current pace. Historically, 4 to 6 months is considered a balanced market. So we're not even near the bottom end of what would have been considered a balanced market, say, pre-Great Recession. And I don't think we're ever going to get back there. I think if we get to 3 months of inventory, that would make a big difference to buyers and make it a lot easier for them. But if mortgage rates continue to drop and more buyers come back to the market, I think we could easily get back to less than 2 months of inventory, back into a place where sellers really do have a significant upper hand.
And then when you think about kind of inventory levels, are enough homes being built?
No, I don't think there's nearly enough homes being built. There was a bit of a building boom during the pandemic, but that boom, it was muted because there were so many challenges with materials, with labor. A lot of projects were started, and those are still coming online now, which is helping to stabilize rents in the South. And if we had more of that kind of construction along the coast, then we wouldn't have this affordable housing problem, or at least it wouldn't be as large as it is now. So I think there's definitely much need for more housing construction, especially in the places where people most want to live.
Do you see that as a problem of kind of where interest rates stand when you think about building and construction costs, especially when you think about these builders? And are all the supply and labor issues in the rearview mirror from the pandemic challenges that we faced?
There are still labor challenges. There's not enough construction labor that could be solved through immigration policy, or at least helped, but we're not there yet. You asked about interest rates as well. Interest rates are a barrier for builders. It makes it more expensive for them to fund their projects, and it is having an impact. I think that's why we are starting to see the slowdown in new construction. There was that boom when interest rates were low. Construction projects take a long time, so we're only now starting to see that construction slow down. And if rates remain high, I think that slowdown will remain a fact. But I'm hopeful that interest rates come down, that we see some more new construction that happens in places where there's been upzoning, where a lot of the red tape has been removed for that new construction. So I'm hoping that this decade is at least better compared to last decade in terms of how many homes get built.
There's nothing wrong with being optimistic, but so then what are you noticing about the trends in the rental market compared to the home buying market? What are you paying attention to?
Rents are starting to creep up, and since people can't afford homes, of course they're going to go to the rental market instead. There has been new construction of apartment buildings in the South, so I don't think there's going to be much pressure on rents there, but there certainly could be pressure on rents in places that already have high housing costs, and people are having to turn to the rental market, which, in a place like Los Angeles or Seattle, there probably isn't enough new construction to keep rents from going up.
And then when you think about kind of the characterization of the housing market of a buyer's versus a seller's market, I know last year you and I have had this conversation about, is it a buyer's, is it a seller's market? I think you were in the camp that is neither. What is it this year to you from your point of view?
I think, well, the tides are turning more in the buyer's favor. For the first time in a long time, homes are selling for below their asking price on average. But it's hard to really call it a buyer's market because it's not like you can come in asking for 10% under asking and expect that to be accepted. Sellers are still holding their ground. They feel like, especially if they have these low mortgage payments that they were able to lock in, they're not going to accept less than what they feel like it's worth to move. So I think that buyers are getting a little bit more power, but the sellers are the ones who really lucked out by getting those low mortgage payments in the first place.
And then for first-time home buyers, is it a really difficult time still to try to get that first home?
Yeah, it's incredibly difficult. I think what makes it, the one good thing is that there really isn't as much competition as there was, say, 2 years ago. And we're seeing a higher share of FHA loans than we've seen historically because those loans, because those borrowers tend to do better when there's not as much competition. But the actual cost of getting a mortgage is so high because of mortgage rates, and then prices are high too. So it's quite unaffordable for first-time home buyers.
And then when you think about factors that are influencing, kind of the accessibility, whether it's the cost or the competition, does your data still show that there are investors out there kind of creating this competition for the first-time home buyer, like corporate investors?
Investors have pulled back just like all buyers. I mean, they're subject to the same forces when it comes to mortgage rates. They see that rents, they're going up a little bit, but not all that much. So investors have pulled back. I think they pulled back just about as much as regular home buyers. So, if you're in a bidding war, there's still probably a 1 in 3 chance that the person who is bidding against you is going to be an investor. But it's not like they remained in the market when everyone else pulled back. They pulled back just like everybody else.
And then what economic indicators are you paying attention to in particular when it comes to kind of the state of the housing market and then kind of the future trajectory over the next few years?
Well, over the next few years, I expect mortgage rates to come back down. I don't think they're going to remain at 6% or high 6%. I think they'll probably settle around 5%. If we're lucky, perhaps around 4%. But the real problem in the housing market is the lack of supply. I'm hopeful that we'll do better in the 2020s than we did in the 2010s, and we'll see more home construction, especially in places that need it the most. There has been a lot of zoning reform. Another thing to keep an eye out for is retiring baby boomers and millennials entering into middle age. For the last couple of years, millennials have been a very big force in the housing market. They're the largest generation. They were entering into home buying age. But in the 2030s, they're going to probably be mostly settled and not such a dominant force as they were before. And Gen Z is a small generation. Generation sizes can change, especially with immigration. But given the current trajectory, I don't think we're going to face so much demand from millennials in the next decade. And that will kind of change the whole housing outlook. If those people are settled in their homes and they're not selling either, it doesn't necessarily mean that prices will go down. It just might mean there won't be as much activity.
So when you think about kind of the demographic shift that's expected to occur with the aging population, does that change? So maybe it may not change demand, but it could change movement. Does that change kind of where you would see? Are you expecting it to see, kind of a territorial change? Like, is it going to be movement in the Northeast to the South? Is that what you're looking out for?
Yeah, we're already seeing that. A lot of people selling right now are retirees who aren't really concerned with mortgage rates because they're planning on selling and downsizing. They're going to buy their next home in cash or they're going to rent it. And that we're seeing a lot of people from California, particularly because they have a lot of home equity given how high California home values are, moving into Nevada, Arizona, Florida, some of those kind of sunny places that retirees tend to like. And when they sell their homes in California, it creates the opportunity now for those homes to be upgraded for, a single family home to turn into a triplex because now by right you can have two ADUs. So I think it's a good thing for housing to turn over because people's needs change and their housing should change along with their needs.
And then speaking of changes along with their needs, are you finding, does the data show you that some of that movement is not just age, but also seeking to find, kind of better tax rates?
Yes, that is a consideration, better tax rates. I think perhaps less so than during the pandemic or before the pandemic. It used to be that if you moved to Texas and Florida, you could perhaps make it ahead on your taxes, but those places have really high property taxes, and now property values are higher. So I would definitely do the math. If you're saving some money on income taxes moving from California to Texas or Florida, look at how much your property taxes are going to be.
And I want to go back to a point that you made about, say older generations who are, moving and maybe buying in cash. What is the challenge that creates, when you think about, say, Gen Z growing up and trying to go for their first home, and maybe they're trying to get a condo compared to an older person trying to get to a condo. What is the friction that could potentially create that you could see from your point of view?
Well, it's not. I think the Gen Z and Boomers do have pretty different needs. They both want some of the same things, like amenities, being close to, say, restaurants and grocery stores. Older people, they tend to need homes that are accessible, single story, or that have elevators, especially if they're getting up in their years. Whereas younger people don't need to consider that so much. I think both tend to like being close to transit. It kind of depends on what kind of baby boomer and Gen Zer we're talking about. But I think the biggest difference is probably that Gen Z needs to be near a place of employment. And if you're retired, that's not really an important factor for you. You can just focus on the other amenities there in a neighborhood.
All right, let's talk about kind of price and what pricing looks like now. The median sales price of previously owned homes that rose this year. It hit an all-time high, more than 419,000. That's going back to we're going back decades now. This is data from the National Association of Realtors. What does the data that you all have at Redfin tell you about the direction of prices? Are they only going to go up?
I expect prices to continue to go up. I think the question is by how much. Right now, home prices are up 4% year over year. Given that the market is starting to shift in buyers' favor, that might slow down, but it could pick up back up again if rates fall, like we discussed. But I think the overall trend is for prices to keep going up next year and the year after. When we get into the 2030s, I think that's when things start to become more vague because it really depends on the state of the economy, demographics, immigration, population, all of those factors.
And then let's go back to kind of, we talked about the expectation for the path of interest rates, and we obviously know that sets the tone for mortgage rates, right? The expectation is generally for market watchers, economists, that we're going to see an interest rate cut this year. If that does happen, right, and sends interest rates or mortgage rates lower, is there still are you still expecting to see kind of an unlocking of home buying, or is there also a risk that home buyers still remain on the sidelines until they see a bigger decline in mortgage rates?
When mortgage rates fall, I do expect to see more buyers making offers. But I think for people who are farther away from the offer stage, it becomes a more complicated question. Do they get in the market now that rates are slightly lower, or do they hold out hoping that rates drop even further? I just talked about how I think that over the next couple of years, rates will continue to drop, but alongside that, prices will continue to rise. So I think it's kind of a circular exercise. And people should probably think more about their personal circumstances, the right time for them in their life. Can they afford it? Is it within their budget? Or are they stretching themselves to decide when is the right time to buy? Because generally, it doesn't hurt to get into the market early. It can hurt to get into the market late.
Oh, because it can certainly hurt to get into the market late. So how does one know that they're ready in terms of the affordability picture?
The general rule of thumb is that if you are ready to settle down for 5 years or more, you are better off buying a home versus renting one. That's when you're making enough in terms of home equity. The ups and downs of the housing market tend to even out. If you were to sell and have to pay real estate fees, you'd have enough equity to pay those real estate fees. If you're going to move in the next, say, 2, 3, 4 years, you're probably better off renting than buying, just because of those costs of moving and selling.
And then let's talk a little bit about later this year. We have an election coming up. What's the impact, if any, that you could see hitting the housing market?
Well, in terms of who becomes the president, they definitely have different economic policies. In general, I think there's more volatility risk with Trump just because it's kind of unpredictable what he might do in another term. And that volatility does impact markets. It increases the spread between mortgages and treasuries when there's a lot of uncertainty in the economy. So I think predictability is good for the housing market, but it's hard. I think that probably the even more honest answer, though, is that presidents don't really have that much control over the economy, over inflation. They can do things to screw it up, but there's not a lot of things they can do to make things better. A lot of that just depends on policies that are beyond their control and circumstances that are beyond their control.
And earlier you talked a little bit about some movement that you're seeing already with aging populations. You talked about Florida, Nevada. What are you noticing in terms of the regions that are showing strength in the housing market and regions where you see weakness?
The places that are seeing weakness are places that were previously seeing a lot of strength. So Florida was seeing really incredible strength during the pandemic and after the pandemic, and it was only really been this year that that strength has slowed down. And that's what happens sometimes in markets. There's a lot of hype, a lot of people move in, prices go up, and it just becomes unsustainable because the reason people move to a place like Florida is because of affordability. And if prices go up, cost of living goes up, then that affordability proposition is not as attractive anymore. So things have to slow down. And that's also, true in a lot of Texas metros as well. And there are other costs going up, like home maintenance costs, insurance costs, which weigh on homeowners and home buyers.
And then, Daryl, I want to ask you, when you kind of think about the trajectory for the housing market over the next 5 to 10 years, what is your projection on, let's take it to 5 years, what's your projection on what you anticipated looking like over the next 5 years?
Okay, so from now until close to the end of the 2020s, I think we're going to see more price growth, and especially if there's lower rates, that would support more price growth. I'm hopeful that we'll see more home supply, not really coming that much from existing inventory, but from new construction. I hope that, our policies align to get more new homes built, and that would support more home sales. But I think the pandemic, it kind of altered the trajectory of the rest of the decade because so many people bought homes during that window when rates were low and locked in that it's hard to see that unraveling itself in a quick manner. I think it will take the next, 4 to 5 years for that to happen.
And then, Daryl, I want to ask you, does the government need to do anything else to help unlock what's happening within the housing market, say tax credits or just any kind of regulation?
This is probably going to be an unpopular suggestion, but property taxes can do a lot. People are locked in because they have these fixed rate mortgages, but there are other parts of owning a home that aren't fixed, like insurance costs, and property taxes is one. But a lot of times homeowners lobby to fix their own property taxes because, of course, who doesn't want their taxes to not go up? It makes sense that they would advocate to fix those, but it just locks them even more into place and gives them an even bigger advantage over first-time home buyers, because when you're buying a home, your property taxes are set at the price that you buy, and you don't get that benefit of locking into whatever home values were, say, 5-10 years ago. So I am against these kinds of programs to lock property taxes. They have it in California. That's what Prop 13 is. And I think it's been really detrimental to California's economy and housing market. And I hope people resist the temptation. It seems like it's an easy fix. It seems like it's the right thing to do for homeowners, but it comes at the cost to first-time home buyers and also to renters who are locked out of being homeowners.
And if there's anyone who's sitting on the sidelines now, but maybe has the cash, especially when you kind of think about just the amount to put down, say 20% or even less than that, is now actually a good time from your point of view?
You can't go back and buy a home in 2021. So I think now is a fine time. It's like that old saying, like the best time to plant a tree was 20 years ago. The second best time is now. I think that's probably also true for the housing market. I think some people, they worry that home values could go down. I think that's a real risk in certain geographies, but it's probably not a broad risk. And if you can afford your payment, I think that's the most important thing. And what happens with the market, you don't really have to pay attention to that until you sell. And chances are by the time you sell, if you're staying for more than 5 years, home values will be higher than they are now.
Daryl, it is always great hearing your perspective. Our thanks to Daryl Fairweather, Chief Economist, Redfin, for joining us. That's it for this edition of Market Overtime. Be sure to catch all of our episodes on the SchwabNetwork.com and on the Schwab Network YouTube page. I'm Diane King Hall. Thank you so much for watching.